Hello, and welcome to the latest edition of the Quarterly View from Glassy Mountain Advisors. I'm Jordan Smythe, the founder of Glassy Mountain Advisors, and it's good to have you back with us for this presentation. I'm going to begin by providing an overview of the stock market's performance in the first quarter of 2023, and then provide our outlook and some investment implications. In summary, stocks climbed in the first quarter despite regional bank collapses, additional rate increases from the U.S. Federal Reserve, ongoing war in Ukraine, concerns about a global economic slowdown, and the potential for recession. This recent rise in stock prices follows a similarly strong performance in the fourth quarter of 2022. As we enter the first quarter earnings season, we expect stocks to remain close to current levels while investors digest the combination of management's adjusted outlooks for the remainder of the year, the impact of Fed rate hikes, and a potential pullback in lending by banks. The U.S. economy may avoid dipping into recession, but a slowdown is still likely. Whatever the short term may bring, we are optimistic about returns from our investments over the long term. The S&P 500 index rose 7.5% in the first quarter, including dividends. Technology stocks rebounded sharply after underperforming last year. Their large presence in major indices like the S&P 500 was one of the most important reasons for the broad market's rally. Stocks in the communications and consumer cyclical sectors also did particularly well. Energy stocks fell with oil prices, financial stocks dropped due to concerns about regional banks, and the real estate sector declined as interest rates rose. The Bloomberg Barclays U.S. Aggregate Bond Index returned 3%, a stark reversal from bonds' dismal performance in 2022. The strength of the stock market may surprise many people, given the disturbing news of several regional bank collapses and ongoing efforts by the Fed to reduce inflation by slowing economic growth. Most glaring were the collapses of both Silicon Valley Bank and Signature Bank, which we addressed in an earlier blog post. We think those failures occurred because of factors specific to those banks, including poor internal risk management, concentrated exposure to venture capital funded clients who quickly panicked at the first signs of trouble, and a large percentage of deposits above FDIC-insured limits. We believe the problems are not spread evenly across all banks, and a wider banking crisis is not imminent. Investors seem to agree with our assessment. While the failures of SVB and Signature Bank caused regional bank stocks to plummet, shares of major banks held up better, partly due to the flow of deposits from the regionals to these larger institutions that investors perceive to be more stable. Some believe the Fed might pause its rate hikes in March in the wake of the bank collapses. However, the Fed remained on course with its rate hikes, boosting the federal funds rate twice during the quarter. Inflation continued to decline modestly in March to 5% over the preceding 12 months, but remained far above the Fed's stated target of 2%. Economic reports released during the first quarter painted a mixed picture. The March employment report showed that job growth tapered but remained strong, with 236,000 new jobs reported in March and the unemployment rate down slightly to 3.5%. Two reports of fourth quarter 2022 activity offered conflicting views of economic health. U.S. GDP increased 2%, partly due to steady consumer spending on services, but corporate earnings dropped 4.6% as wage increases and other higher costs weighed on profit margins. Whether or not the U.S. economy avoids a recession, we expect economic growth to slow as the Fed continues to battle inflation with additional rate hikes. Banks may also curb lending amidst fallout from the recent regional bank collapses, the potential for tighter regulation, and concerns about the economic outlook. Consumer spending, which accounts for about 70% of U.S. GDP, has been relatively strong but may weaken. Wage gains have slowed, easing pressure on employers and potentially dampening price increases. The question remains, however, whether consumers will maintain spending power to keep up with inflation. If not, consumers may pull back on spending, a shift that could send the economy into recession. Inflation will likely moderate further over the coming months. As inflation wanes and the economy slows, the Fed may pause rate hikes as soon as this year and could turn to rate cuts by 2024. Analysts predict corporate earnings will decline close to 7% for the first quarter of 2023, which would mark the second straight quarterly drop and the largest quarterly decline since the second quarter of 2020, just after the onset of the COVID-19 pandemic. Analysts currently forecast a resurgence of earnings growth later in 2023 and a slight increase in earnings for the full year, but we expect a decline in earnings for all of 2023. Given our expectation of a slowing economy and lower earnings, what are the implications for investment opportunities and potential returns? With the broad stock market still trading almost 15% below the peak levels at the end of 2021, we like the prospects of the stocks we own in our portfolios and have been able to find new stocks to add to our holdings at prices that we consider attractive for long-term returns. The S&P 500 index currently trades for about 18 times estimated earnings for the next 12 months, lower than the average over the past 5 years, and we believe there are specific stocks trading for significant discounts to their fair values. Meanwhile, the rise in interest rates has made bonds much more attractive. We welcome yields of more than 4% on short-term treasuries and other bonds after many years of paltry returns on fixed income securities. Other sectors of the bond market, such as floating rate notes, select high-yield bonds, and municipal bonds, also offer appealing yields and prospective returns currently. As always, we will be closely monitoring economic indicators and the Fed's actions over the coming months. We are optimistic that fallout from recent issues with regional banks will be limited and are prepared for an economic slowdown that we expect will be short-lived. We do not anticipate significant changes to our portfolios, but remain on the lookout for good long-term investment opportunities. Thank you for taking the time to join us. We hope you enjoyed this presentation. We welcome your questions, comments, or suggestions, and we look forward to talking with you or seeing you sometime soon. Happy spring. Take care.